right. Hello, everybody. Welcome this Tuesday afternoon. Boy, I put that up there, hello, Gene, because usually he's got it preset to say hello to everybody right as we start. Kevin, how you doing? Hopefully everybody can hear and see me okay. We good to go here today, folks, on this cold and rainy day here in Chicago. It's actually blustery, terrible, terrible weather here in Chicago. All right. There we go. All right. Quiet day in the market. Again, not a bad thing. Not a bad thing to build a base here. S&P is down about 12 points right now. The Dow is down just under 100. Nasdaq's down about 40. And we've had some really good trade. Some really good trade going on. New comments here. Well, let's go, Carlos. Let's go. Kent, where are you? Where it's going to be 99 today. Not here. That's for sure. Kent, where are you at? Are you in Arizona? All right. So we're going to talk about IV Crush, which we can kind of relate that to yesterday's diagonal conversation, but you're in Phoenix, got it. We need to know what happens with implied volatility. Before we start here, guys, please hit that subscribe, smash, like, all that good stuff that we see there. Let's actually, I'm going to check live here and see how many we got. Come on, I just smashed it, so that's only 13. Come on. Let's go. Let me see it get up to 17 before we start here, please. I'm watching this live. I don't see that thumb moving, guys. I don't see that smash moving. 20. There we go. Wonderful. Boom, boom, boom. Thank you. How do we trade the post-earnings crush? Or how do we treat IV? Okay, and I use this in reference to implied volatility for earnings because we know that there is going to be a crush. Okay, I don't know about any of you guys, but back in the day, these were the only two crushes I knew, Orange Crush and Grape Crush. And boy, was that a treat. Was that a treat, having one of those on a hot summer day growing up. Now I guess there's all these, fancy schmancy, just like every other flavored water soda has a gazillion different flavors, but that was it back in the day. Okay, how do we know it's going to happen? How do we know the IV crush is going to happen? When will it happen? How much? And what is the difference or correlation between Vega and implied volatility? Okay, so important to understand all of this. So let's take a look at this, what I have here. Okay, what is Vega? Okay, Vega is the Greek that measures an option's sensitivity to implied volatility. Just like delta measures the change in the value of an option as a stock moves $1. Okay, Vega measures the change in the value of an option as implied volatility moves 1 percentage point. Okay, delta, direction, stock movement. Vega, implied volatility. Okay, does everybody understand that? Vega is a Chevrolet small car from the 70s. Yes. It sure is. It sure is. Okay, now we can't confuse volatility with Vega, even though VV. So when I try and explain to people for the first time about implied volatility in Vega and getting the correlation, I always say, just remember the V's, volatility and Vega. They go together. Okay. What is volatility? Volatility can be broken down into two different pieces. Historical volatility, which is what has happened in the past, and we know what it was. And then implied volatility, which is exactly the meaning, the unknown of what may happen in the future. And that's based off of past performance. Okay, so future volatility is based off of prior volatility. So if we look at this chart, okay, and we break down time to expiration and also where an option is relative to where the stock is, a couple things that we can see pretty quickly here. The further you go out in time, the higher the Vega is. The more volatility risk there is. It's because there's more time for that something can happen. So an option that is 30 days out is going to be more sensitive to a change in volatility than an option that's a week out. An option that's a year out is going to be more sensitive to an option that's 6 months out. Okay? Now, in terms of which options have the most sensitivity to a change in implied volatility, it's the options closest to being at the money. Okay, let me bring in a live chart here. I don't know, bring up Palantir. I don't know. Makes no difference really. Okay, so here is Palantir. And we're just going to look right at the monies here. And if we look, stock is basically 127. If we look at 127 here, okay, and we look at the Vega column, we can see that Vega is 4.67. Does everybody see that? Everybody see that? Okay, what does that mean? That means that for every 1 percentage point move in implied vol, the value of that option is going to change by 4.67 cents. So if implied volatility for that option went up, let's say by 2 percentage points, the value of that option is going to go up by 9.34. If vol dropped by 10 points, the value of that option is going to lose almost 47 cents. Okay. Now, what you will notice on my charts that I use here, and even on my Thinkorswim, I only choose to show Vega on one side of the ledger. Calls on the left, puts on the right. And the reason being for that is, you'll see that I don't have it over here. The reason for that is Vega for an option, okay, same strike, same for a call or a put. So the Vega of the 127 option, call or put, is 4.67 cents. Okay? Does everybody understand that? Gamma risk we'll go into another time, Alex, because that's just going to confuse everybody today, or I'm happy to have a convo with you offline about it. Okay, so if we look at the options here again at the money, and then the further we go away, whether in the money, out of the money, the further we go away, what do you see happening to the Vega? It gets less and less and less sensitive to a move in implied volatility. So the further out of the money or in the money that an option is, the less sensitive it is to a change in implied volatility. So at the money options have the highest Vega sensitivity. Okay, now let's look at time to expiration. This is next week, May 23rd. It was 4.67 cents for the at the money. Let's go out a month. Okay, if we go out 1 month, June 20th, we can see that Vega is basically 3x. It's now 14.7 cents. So it takes less of a move in implied volatility to really impact the value of that option. Does everyone see that? And then if we go even further out, let's go to January of next year. We can see that Vega is now almost all the way up to 39 cents. Further you go out in time, the more variability, the more impact a change in volatility is going to have to the price of your option. Okay. All right. So at the money has the highest Vega. Further you go out in time has higher Vega. What happens to your position when implied vol increases? Okay. Now remember, Vega is agnostic to whether you have a call or a put. Okay. So if you are long Vega and implied volatility goes higher, the value of those options are going to move higher as well, regardless of whether it is a call or a put. If you own options, if you are long an option, call or put, and the implied vol goes down, the value of that option will become worth less. Again, it does not matter call or put. Calls and puts have the same Vega on the same line, same expiration. Okay? Now, the key to understanding implied volatility and understanding the implied volatility crush is understanding and knowing and believing that volatility is mean reverting. Volatility is mean reverting. Now, what the heck does that mean? Here is an implied volatility chart in Palantir. Okay, this is over 1 year's time. Okay, it looks just like a stock chart. This is the implied volatility chart. And what you can see is when we get down here too cheap, we do see it going up. And when it gets up here too expensive, we see it coming down. And it is eventually going to find its mid-level. That's what we mean by mean reverting. And this happens 100% of the time. When it's up here, it is absolutely coming down. When it's down here, it is absolutely going up. What we don't know is when that's going to happen. Whether it's going to be imminent, a couple days, weeks. But we do know that that mean reversion is going to happen with 100% certainty. Which brings us to the IV crush around earnings. Okay, when we're approaching earnings, as we are in Snowflake, right? Earnings coming up tomorrow after the close. Okay, or when we look at any other stock with earnings, we always see a big spike up in implied volatility heading into earnings. Why is that? Why is that? Uncertainty versus certainty. Exactly. When we see the spikes up here, that is because we don't know what's going on. And that typically, unless it's a 100% market moving event, that is typically around earnings. And we know around earnings or at earnings, company's going to come out typically 4 times a year, once a quarter, and they're going to deliver news about the company that is very essential, very important, giving guidance, giving, profitability performance. And they're going to do that once a month, and they don't do it the other 89 days of the quarter. So the anticipation leading up to that leads to the uncertainty, leads to vol going up. But then as soon as, in the case of earnings, as soon as literally the news is out, whether that news is good, bad, or indifferent, whether the stock is unchanged, up big, down big, we see that IV crush. I think everybody understands that, right? Okay. Now, question is, all right, you might understand the concept of this, that volatility is mean reverting. But to really trade this effectively and efficiently, we got to know how much it's going to correct. Not just that it will correct, which we know is going to happen, but how much is it going to correct? Before we do that, let's get to our friend here. Okay, get that in there, guys. We'll go with the green crush. I prefer the orange crush myself. We'll go with the green crush here today. Anybody here, while we're waiting for people to put that in there, anybody here happen to be a former Illini like myself? Because our Illinois colors orange and blue, so we were, the student section was called the Orange Crush section. All right, give that another 5-10 seconds or so here. Those of you, oh, there you go, Thomas. Beautiful. Beautiful. Love that. Those of you who are in the Zoom position right now, by the way, there was just some news that came out, not earnings. We do have an earnings play on. There was just some news that came out that Google looks like they're launching their own sort of Zoom platform. So you all should see the screen now. I went back to our screen here because I want to look live. I'm listening to what they're saying about this headline here. So you could see the strangle swap we put out there widened out a little bit. William, I think we're at 345 if I'm not mistaken in GLD. It widened out a bit because vol is picking up there, which for those that are filled, that's a good thing right now. Okay, back to our presentation. So we know after earnings, which are after the close tomorrow, come Thursday morning, regardless what happens to Snowflake, that vol is going to come crashing down. But the key is, how much is it going to come crashing down? Let's take a look. Okay, here is Snowflake. Here's the option montage. This was just from a short while ago. And we can see stock was 182 when I did this. So if we look right here, the current implied volatility on this week's at the money, 133% basically. That's not the Vega, that's the implied volatility. The Vega to that is 7 cents. Just over 7 cents. Does everybody see that? That's the pre-earnings implied volatility. Okay, let's compare that to next week's pre-earnings volatility. Same strike. That vol was only 83%. Not only, that's still really expensive, but we had 132 for this week's options, which are the ones going to be most affected by the earnings announcement, and 83 for next week. So you might just look at that and say, oh man, how could I lose? I've got to sell a 132 implied vol to buy 83, right? That's 50 points of arbitrage, right? How could that not work out for me? Right? It would make sense that that would be a massive, massive hedge. Okay. But let's go back for a second to our Snowflake implied volatility. Okay. What would everybody say is a fair, an average implied volatility in Snowflake? What would everybody say would be a cheap implied volatility in Snowflake? Okay, good. 40 is probably cheap. Yeah, right in here. Great. If vol ever got down to 40 implied vol in Snowflake, regardless of direction, whatever you think in, bullish, bearish, whatever it is, you want to buy it there. Okay, 50-ish average. Okay, great. I'd go with that. Okay, so now we have a baseline. Now we have a benchmark for where implied vol may get crushed to after earnings come out. So going back here, here is what I did in Snowflake to adjust for the implied volatilities. Okay, the options that get affected most, which are the near term option here, okay, I usually cut those by about half. So you can see I took down the implied vol in our short option here, which is the one this week, from about 130 and change down to 70. Even though 70 is still really expensive looking at the implied vol chart in Snowflake, that's what I adjusted it to, because that's what we typically see is about a 50% decrease. Okay, does everybody see that? And it looks like we have a last call for the crush here. I'm hoping everybody can still hear and see me, since Harris, you said you lost your screen. Can everybody still hear me? Okay, great. Thank you. Okay. Now, every subsequent expiration going out, whether it's a week, 2 weeks, 4 weeks, is going to get reduced on its mean reversion by a little bit less, little bit less, little bit less. So if we took 50% for this week's reduction, look what I did for next week's. A little bit less than that. Took it down about 40 to 45%, which That now brings me really into line with what we had just talked about previously, with 40 being really cheap, 50 being kind of midline average. Does that make sense? Does that make sense? Okay, so what do you make of this? Well, here is, if we were to do just a calendar call spread, and I'm doing this because these are the two options that I just went through. Okay, selling this week's at the money 182.5, buying next week's at the money 182.5. Okay, you can see that the market is really 45-cent bid offered at 90 cents. Okay, but I'm showing a value, a theoretical, which is not the midpoint of what it's showing there. I'm showing a value of only 44 cents or so, when the real market is showing a midpoint of 65 or almost 70 cents. The reason being is because this has already taken into account the volatility crush of what we believe will happen. And we're never going to get that crush exactly to the penny. We'll be really darn close. We will be really, really darn close. Okay, so I want to show you now what the P&L might look for something like this. Okay, if I put the date ahead to this Friday, this P&L that we see up here is taking into consideration vol crush. If you were just to put this trade into your Thinkorswim platform or whatever other platform you're using and run a P&L scenario, not adjusting volatility, look at the difference. It is going to show you something that you would say, holy cow, this is an unbelievable potential reward to risk. How could I not do this? So if the vols remain the same in Snowflake with that same position we just had on, your P&L is going to look like this down here. There ain't no way that is real. This is why it is imperative to understand when there's going to be a vol crush. Okay, does everybody understand that? Does everybody understand that? Now, this right here, I just put the adjusted implied vols back in, and you can see the massive difference in projected P&L. I don't expect you to be able to pick up and say, okay, let's look at a scenario. This is what we're going to adjust implied vols to. I don't expect you to pick that up just looking at this one time, but just understanding that the crush is real, it does happen, and you must understand it and use it in your calculations. That is what you have to know. All right, everybody. John Gebhardt won yesterday. So if you're on here, John, you won't be able to win today. Are we ready to spin away, guys? Ready for the spinorama? Let's do it. And Elisa, are you in the house? Elisa, yes, that was quick. That was really quick. All right, congrats, Elisa. You see the comment across the screen there. Please email me your swag size and your address, prosperswag@prospertrading.com. And if you do that within the next few minutes, that will actually go out today because there is swag getting sent today. Okay. Thank you, everybody. Keep the suggestions flowing for what might be next. I will not be doing market minds tomorrow. I believe Mike Shore is. Let me see. Let me make sure. I will be on my way out to Colorado. Yes, Mike Shore will be tomorrow. Any topic? The wheel already went, Kevin. Yes, Elisa is the winner. There, right there. Any suggestions for Mike for tomorrow? Managing a losing trade, expected moves before earnings. These are all good. Okay. Ping him right now. Connie, too late for today. We've already spun the wheel. Too late for today. I just pinged Mike Shore about this topic for tomorrow, and he said, perfect. I almost understand that. Thank you, Mike. All right, guys. Appreciate everybody. Appreciate tomorrow. Mike will be with you. Market just kind of hanging here right now, and we'll see you later. Have a great day, everybody. Watch GLD here, guys. GLD is ripping to a daily high. Talk to you later, everybody. Bye-bye.